Hook and promise. Why do smart, well-informed people sometimes do downright puzzling things with their money when markets start to tumble? It's like watching a perfectly good car suddenly swerve off the road at the first sign of rain. Today on the Capital Breakdown, we're diving into the psychology behind market crashes and, more importantly, how you can stay calm and clear-headed when others are panicking. By the end of this video, you'll understand why emotions often take the wheel during downturns, what's really going on behind the scenes, and practical ways to keep your cool so you can make thoughtful decisions, not impulsive ones. The problem or confusion. The truth is, most people don't realize how much their emotions influence financial decisions, especially during market drops. Imagine watching your portfolio shrink in value day after day. It feels like watching your paycheck evaporate. The natural reaction? Panic. People rush to sell, thinking they're avoiding losses, but often they lock in those losses instead. It's like dropping a fragile vase just because it's wobbling. The confusion comes from thinking that markets falling means permanent damage, rather than a normal part of investing's ups and downs. This misunderstanding leads to mistakes that can cost far more than the actual market swings. Core concept explained. At the heart of this is something called behavioral finance, which studies how psychology affects financial choices. Think of your brain as a driver navigating a winding road. When the road is smooth and sunny, it's easy to stay calm and steady. But when the road suddenly turns slippery or foggy, like during a market crash, fear and uncertainty can make you slam the brakes or swerve. This emotional driving often overrides your better judgment. Key terms here are loss aversion, meaning losses hurt more than gains feel good, and hurting, when people follow the crowd without thinking. Recognizing these patterns is the first step to steering your money journey more safely. Core concept explained, continued. Imagine your investments as a garden with different types of plants. Some are sturdy perennials that take time to grow. Others are delicate annuals that bloom quickly but need careful attention. When a storm hits, it's tempting to pull out all the plants to save them, but that can do more harm than good. Instead, understanding which plants are resilient and which need protection helps you weather the storm. Similarly, knowing your emotional triggers and how markets work lets you avoid knee-jerk reactions and stick with a plan designed for long-term growth. How it actually works. Behind the scenes, the market is a vast ecosystem with many players. Retail investors like you and me, large institutional investors, fund managers, brokers, and regulators. When news hits that scares investors, many start selling their shares, which pushes prices down further. Fund providers try to manage risk by adjusting portfolios, and brokers facilitate trades that can happen in milliseconds. This rapid buying and selling creates volatility, but also liquidity, meaning you can usually buy or sell without huge delays. Fees and commissions, while generally lower than in the past, still eat into returns over time. And regulatory rules aim to keep the system fair and orderly. Understanding this flow helps demystify sudden market moves and reduces fear. How it actually works. Continued. Money flows like water in this system. When optimism flows, prices rise. When fear flows, prices fall. But unlike a faucet, emotional reactions can cause sudden surges or droughts. This is why markets can swing wildly on short notice. Regulators sometimes step in to pause trading during extreme drops to prevent chaos, but these are exceptions, not the rule. Recognizing that some volatility is baked into the system and even necessary for price discovery can help you view market crashes not as disasters, but as opportunities to understand the market's natural rhythm. Simple, concrete examples. Let's say you have two friends. One invests a fixed amount into a broad index fund every month, regardless of what the market is doing. When the market dips, this friend buys more shares at lower prices, which can boost returns over the long haul. Emotionally, it can be tough during those down months, but sticking to the plan smooths out the ride. The other friend chases a single speculative stock, buying high during excitement and panicking to sell when prices fall sharply. This roller coaster approach often leads to bigger losses and stress. These examples show how steady, diversified investing contrasts with risky, reactive trading, both financially and emotionally. Simple, concrete examples continued. Think of the first friend's approach like filling a bucket with water drop by drop, even when the faucet sputters. The bucket steadily fills over time. The second friend is trying to catch rushing water with a sieve, exciting but unreliable and often frustrating. Neither approach is guaranteed, but understanding the emotional challenges behind each helps you appreciate why patience and diversification are often your best allies in turbulent markets. Risks, traps, and common mistakes. Where do most people get tripped up? One big trap is concentration, putting too much money in a single stock or sector. When that area crashes, it can wipe out a big chunk of your portfolio quickly. Leverage, or borrowing money to invest, amplifies gains but also magnifies losses, turning a small drop into a big headache. Another common mistake is ignoring your time horizon, selling investments intended for decades at the first sign of trouble. Volatility, or price swings, is normal, but impatience and unrealistic expectations turn that normal into panic. The key is recognizing these risks and building a plan that matches your comfort level and goals. Risks, traps, and common mistakes continued. It's also easy to fall into the trap of chasing returns after a crash, buying back in too soon when the market feels like it's recovered. This can lead to buying at high prices again, repeating the cycle. Understanding that markets usually recover over time, but not always on a predictable schedule, helps set realistic expectations. Remember, investing isn't a sprint. It's a marathon, and keeping your emotions in check is like pacing yourself so you finish strong. How to think about this tool. Putting this all together, think of investing as one part of your broader financial life. Before you even think about the market, having a solid budget and an emergency fund is like building a safety net beneath your tightrope walk. Your investment strategy should align with your goals, whether that's retirement decades away or a shorter-term purchase, and your personal risk tolerance. The idea isn't to eliminate risk, that's impossible, but to understand it, manage it, and stay disciplined. When markets wobble, your foundation keeps you steady, letting you make decisions from a place of calm rather than panic. Have a think about this tool. Continued. Remember, no tool or strategy is one size fits all. The Capital Breakdown encourages you to blend knowledge with self-awareness, so your financial decisions reflect both smart planning and emotional resilience. When you view market swings as a natural part of the journey, you're less likely to be driven by fear or greed, and more likely to stay on course toward your long-term goals. Recap and educational disclaimer. To wrap up, we learned that market crashes often trigger emotional reactions that can lead to costly mistakes, but understanding behavioral finance helps us stay grounded. We explored how markets operate behind the scenes, why steady, diversified investing often outperforms reactive trading, and the importance of patience and realistic expectations. Remember, this video is for educational purposes only, not personalized financial advice. Always do your own research and consider talking to a qualified professional before making investment decisions. Thanks for breaking down the capital with us today. Stay curious, stay calm, and keep building your financial confidence. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.